Gold isn't rallying, it's being repriced, and the people still hiding in cash are about to learn why that matters this week. Because the conflict isn't gold versus stocks, it's gold versus comfort. Cash has been marketed as the safe place to wait, the clean place to think, the place where nothing can hurt you. And that story holds right up until volatility creeps back into the room and cash quietly stops behaving like a shelter and starts behaving like an exposed position in a promise. And here's the part most people miss. The headline price is not the signal. The signal is where the stress shows up first, inside the plumbing, inside the how of the market, not the what. And if you stay with me, you're going to walk away with 3 concrete things. The level that forces decision-making, the calendar window that can amplify the move, and the checklist for what confirms this rotation over the next 1 to 2 weeks. Start with the fact pattern nobody can ignore. Gold just pushed through the $5,000 handle, an entirely different psychological regime. It wasn't a gentle drift, it was a shove. It tagged above that level, it traded into the low 5,000s, and it did it while the world was already on edge. That's not a nice chart. That's a market forcing you to look at something you were trying not to look at. When an asset prints a regime shift, the story stops being sentiment and starts being positioning. Because the big money doesn't move on vibes, it moves on constraints, mandates, correlations, risk models, collateral. And the moment a new price regime is established, a whole group of participants who were previously allowed to ignore it suddenly aren't. This is where the first open loop matters. The real catalyst isn't fear, it's math. And if you understand the math, you stop getting whipsawed by the emotions that the math creates. So let's talk about the quiet trap sitting under the cash is king narrative. Cash feels safe because the number doesn't move. You don't open your account and see a red candle. You don't get that sick feeling in your chest. But cash has a hidden volatility, purchasing power, policy risk, and currency stress. It's not marked to market the way a traded asset is, but it absolutely is marked to reality. In calm markets, you can get away with pretending cash is neutral. In unstable markets, cash becomes a bet on the stability of the unit itself. And that's a very different bet than most people think they're making. Now layer in the macro backdrop that's been building pressure, debt concerns, fiscal direction, policy credibility, and geopolitical friction. You can argue about politics all day. The market doesn't argue. The market prices incentives. If participants start to believe that policymakers are boxed in, too much debt, too many promises, too little tolerance for recession, then a very old trade starts to wake up, the debasement hedge. Not because someone is pressing a devalue button like a cartoon villain, but because the incentives tilt towards keep the system liquid and keep funding costs manageable. And that usually means real yields can't be allowed to stay too restrictive for too long. And that's where cash starts to feel less like a throne and more like a target. But that's not the part that matters most. The underappreciated detail, the one that reframes this entire rotation, is how time and delivery are being priced. Because gold trades in 2 worlds at once. There's the screen price, mostly discovered through leveraged paper markets. Futures, options, swaps, hedges, synthetic exposure. And then there's the physical world. Bars, vaults refinery output, logistics settlement preferences, and the simple reality that if enough people want the same thing at the same time, the system can get tight in places you don't see on a basic price chart. I'm not talking about conspiracy, I'm talking about structure. Here's the simple way to think about it. In a paper market, you can create exposure with a keystroke. In a physical market, you can't. Physical has lead times, assay, refining, transportation, allocation, inventory categories. And the moment demand shifts from I want exposure to I want the thing, the market starts to express stress through spreads, premiums, and the cost of immediacy. That's why watching only spot price can make you late. Spot price is the headline. The stress shows up in the mechanics. So what does that mean for you? Right now, today, this week? It means the safe haven rotation you're seeing isn't only a fear trade. It's a repricing of collateral confidence. It ants a repricing of what counts as a reliable store of value when the default settings, but of markets, stable bonds, stable currency, stable policy reaction function, start to wobble. And you can see the scaffolding of that wobble in at least 5 different proof points. First proof point, cross-asset volatility is creeping back. Not always as a dramatic spike, but as persistent instability. Rates swinging, FX reacting, risk appetite getting jumpy. Volatility doesn't need to explode to matter. Sometimes it's worse when it creeps, because creeping volatility forces slow deleveraging instead of one clean flush. That's where the real pressure starts. When funds run risk models, they don't care that your narrative is long-term, and they care about near-term volatility and correlation. If bonds stop hedging stocks the way they used to, or if currency moves start contaminating everything, risk managers do what risk managers always do. They trim. They reduce gross. They look for diversifiers that don't depend on somebody else's promise. Gold is one of the few assets that can sit in that category in the minds of institutions. Second proof point, the bond signal is flashing in a way that changes gold's role. Historically, gold struggled when real yields rose. The logic was clean. Higher real yields raise the opportunity cost of holding a non-yielding asset. But markets are not obligated to follow the textbook when the textbook assumptions break. If participants start to interpret rising yields not as growth and stability, but as funding stress and fiscal concern, then yields can rise and gold can rise too. That looks wrong until you realize the driver changed. If bonds feel less like a risk-free anchor and more like a policy instrument sitting on a mountain of issuance, then the entire portfolio hierarchy shifts. Gold stops being a trade you put on when you're scared of inflation. It becomes a hedge you hold when you unsure about the credibility of balance sheets and the political tolerance for austerity. And that's not a fringe idea. You can hear it in how people talk now. Less about CPI next month, more about debt trajectory, of funding, currency confidence, who is the marginal buyer of sovereign paper. It's not the same conversation. And that's why this move isn't emotion, it's math. Third proof point, institutional behavior is changing. Institutions don't chase headlines. They chase mandates and correlations and what stops working during stress. When an asset breaks into a new regime, it can trigger mechanical behavior. Risk parity, balanced portfolios, volatility target strategies, and big allocators that run systematic rebalancing, all of them can be forced to reconsider weights when the underlying assumptions shift. And here was the uncomfortable truth. A lot of large players do not buy because they believe. They buy because their models tell them they must, or because their mandates require a hedge, or because they need a diversifier to satisfy a committee, or because their competitors are doing it and underperformance becomes career risk. The market doesn't care whether the buying is poetic. It cares that it's real. Fourth proof point, the strategic bid, central banks. This is the buyer class that doesn't care about your entry price the way traders do. They care about reserves, credibility, and geopolitical optionality. When central banks add gold, it's not a day trade. It's a strategic preference for an asset that isn't someone else's liability. And even if you debate how much of the latest move is directly caused by central bank buying versus private flows, the important point is the same. There is a durable base of demand that tends to be less sensitive to short-term technical pullbacks. That changes the market's floor behavior. It doesn't guarantee anything. It doesn't prevent drawdowns, but it changes the character of dips. Dips become opportunities for the strategic bid, not just exits for weak hands. Fifth proof point, the bridge between retail and institutional behavior, ETFs and ETPs. When flows into gold-backed products shift from a trickle to a tap, it matters for one reason, plumbing. It can translate into physical allocation requirements, inventory movement, and a tightening of available supply in specific forms. Again, not conspiracy, mechanics. When you add persistent demand to a market already dealing with logistics and inventory categories, you can get moments where the paper price has to catch up to physical reality. Now stack those 5 proof points together and you get a structure that supports a safe haven rotation, even if the headlines change tomorrow. That's the key. This move isn't one tweet away from disappearing. It's sitting on underlying incentives and constraints. But the next detail is what flips the whole setup. The timing. Markets don't move in a smooth line. They move around deadlines, around resets, around expiries, around liquidity holes. And right now, you're walking into exactly the kind of calendar window that can turn a slow burn into a sharp move. Month-end matters because it forces rebalancing. It forces reporting behavior. It forces risk teams to look at exposures and ask, do we really want to carry this through the next window? Quarter and year-end are even bigger, but month-end can still bite, especially when price is sitting at a psychologically violent level like $5,000. Options matter because options create reflexivity. Here's the clean explanation without the jargon dump. When traders buy call options, dealers who sell those calls often hedge by buying the underlying. The more the price rises, the more they may have to buy to stay hedged, depending on where the options are and what the gamma looks like. This can create a feedback loop where price rises, force more buying, which pushes price higher, which forces more buying. It's not magic, it's mechanical. And when you're at a fresh regime high, the strike map tends to cluster. People like round numbers. They like clean levels. They like, it breaks $5,000, it goes. That kind of crowding can make the hedging flows more concentrated than usual. Liquidity thins, hedging accelerates, and you can get those vertical moves that feel like the market is running away from you. But that's not the only calendar lever. Delivery windows and settlement preferences can matter in precious metals because they influence how participants roll exposure and how they value immediacy. You don't need to be a delivery expert to understand the concept. If immediacy becomes more valuable, the market expresses it, sometimes through spreads, sometimes through premiums. sometimes through the way the front part of the curve behaves relative to the back. And here is the hidden detail, stated plainly: when the market starts paying up for immediacy, it's telling you the demand is urgent, not just speculative, urgent. Now, I'm going to be careful here. I'm not going to pretend I can see every warehouse number in real time or quote you some fake inventory collapse figure. That's not how trust is built. But you can still read the market honestly by watching the symptoms that typically show up when tightness and urgency increase. How quickly dips are bought, whether pullbacks hold above key levels, whether the structure of the move is impulsive or sloppy, and whether the related metals, like silver, start confirming with their own behavior. And that's why this isn't just a gold story. It's a volatility story. It's a collateral story. It's a where do you hide when the hiding places start moving story. Now let's address the counterpoints, because this is where credibility lives. There are real ways this can unwind fast. If the US dollar rips higher in a sustained way, that can pressure gold. If real yields spike sharply because the market suddenly believes policy will stay restrictive and credible without breaking anything, that can pressure gold. If risk sentiment flips hard into everything is fine and equities melt up while bonds stabilize, you can see a rotation back out of safe havens. And the big one, forced liquidation. In a real volatility event, even good hedges get sold temporarily because people raise cash to meet margin calls. Gold can drop in the short run even when the long run thesis remains intact. That last point is the one most people refuse to internalize until it's too late. Price can whip around violently even if the thesis is correct. So your job isn't to predict a straight line. Your job is to separate trend signal from noise and to know what invalidates your view. And that brings us to the two scenario lens you need for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. In this scenario, gold holds the psychological breakout zone. Think around the $5,000 handle, and you see the market try to shake people out. You get sharp intraday wicks. You get headlines designed to calm you down. You get commentators telling you the move is overextended. But the pullback is contained. Dips are absorbed, and the next push higher is built on a base. This is the scenario that often feels the worst emotionally because it's slow enough to torture you, but not clean enough to reassure you. It's where traders get chopped up. It's where investors second guess. It's where the market extracts the maximum amount of frustration. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, gold doesn't give you the polite retest. It grinds, then it jumps. Liquidity thins, especially around key strikes and round numbers. Dealers hedge. Shorts feel the heat. Stop orders get triggered. And you can get an acceleration move that leaves people staring at the chart saying, I'll buy the next pullback, while the pullback never comes. This scenario is where the market punishes hesitation. It's also where the market often sets traps later, because after squeeze or you can get violent snapbacks. So you don't want to be emotionally drunk on momentum. You want to be mechanically sober. So what confirms each scenario? For the controlled pullback retest, confirmation looks like this. Price holds above the breakout zone on a closing basis, pullbacks get bought with urgency, and volatility doesn't explode. You see stability in the underlying drivers. FX isn't suddenly reversing, rates aren't suddenly collapsing into calm, and risk sentiment isn't turning euphoric. In other words, the market digests, not collapses. For the squeeze continuation, confirmation looks like this: repeated holds above 5,000, rapid reclaim if the level is briefly lost, and upside moves that happen during thin liquidity windows. Overnight, early session, around key macro prints or near option-related pinpoints where hedging flows can cascade. Now, levels. Don't worship price. Track the levels that force other people to act. The $5,000 handle is the center of gravity because it's where psychology and mechanics collide. Above it, you force underweight allocators to explain themselves. You force systematic strategies to reevaluate exposure. You force short sellers to manage pain. You force options hedging flows to react. Below it, you give the market a chance to claim the breakout was fake, which invites pressure and tests conviction. So the first level is simple. Can price hold above $5,000 with authority, not just touch it? The second level is the recent peak zone in the low 5,000s, the area that represents maximum excitement. If gold churns there and then breaks higher, that's a signal of acceptance. If it rejects hard and repeatedly, that's a signal of temporary exhaustion. And the third level is the line in the sand that matters for the thesis in the near term. If gold loses the breakout zone and stays below it for multiple sessions, while the dollar strengthens and real yields rise, then the near-term squeeze narrative weakens. Not forever, not in the cosmic sense, but in the this week and next week sense. Because if this one level breaks, the math changes. Now let's translate the mechanics into what it forces participants to do, because that's where actionable understanding lives. When gold is above a major breakout level, Underweight institutions feel pressure because they're underperforming a rising hedge. They either buy, or they rationalize, or they get fired. That's not drama. That's how committees work. When gold is at a round number with options interest clustered nearby, dealers have to hedge dynamically. They buy when price rises, they sell when price falls, and that can either dampen or amplify moves depending on the gamma profile. When gamma flips the wrong way, volatility can expand quickly. When volatility creeps across macro assets, risk models force degrossing. That can create selling pressure in unrelated assets, which ironically can increase demand for hedges. Reflexivity isn't just in one instrument, it's across the system. When people who thought cash was safe realize cash is a bet on policy credibility, they look for alternatives that don't require trust. Some go to gold, some go to other real assets, some go to foreign currencies. The rotation doesn't have to be total to matter, it just has to be persistent. And that's where the real pressure starts. Now I want to give you the viewer psychology shield, because if you don't have it, volatility will take your position whether you're right or wrong. The market's favorite trick is to make you emotionally pay for being early, even when you're directionally right. It does it with fake breakdowns, quick spikes down that trigger stops, sharp reversals that make you feel stupid for holding. It does it with narrative whiplash. One day you're a genius, the next day you're an idiot, based on nothing but a candle. And the reason that works is because most people confuse noise with signal. They treat every move as meaning. They anchor to the last price they saw. They make decisions in the emotional heat of a 5-minute chart while claiming they're long-term. So here's the shield, simple and brutal. 1, decide your time horizon before the market decides it for you. If your horizon is weeks, don't let a 30-minute wick dictate your identity. 2, size so you can survive volatility. If the position size is so big that a normal pullback makes you panic, then you didn't buy a thesis, you bought a stress test. 3, separate trend signal from noise. Trend signal is structural. Regime break, sustained holds above key levels, confirmation from macro drivers and flows. Noise is intraday drama, headline games, and the market hunting liquidity. 4, respect the 2-scenario lens. If you only believe in one path, straight up, you are emotionally fragile. If you accept both scenarios, retest or squeeze, you stop being surprised, and surprise is what causes bad decisions. And 5, always know what invalidates your thesis. Not what scares you, not what annoys you. What actually breaks the mechanism. That's how you keep trust with yourself. Now, what comes next over the next 1 to 2 weeks? Expect the tape to look like chaos. Expect sharp pullbacks that feel like the end of the world. Expect sudden rips that feel like you missed everything. And expect the loudest voices to show up precisely when it's hardest to think. But the mechanics will be unusually readable if you watch the right things. Watch the behavior around $5,000. Not the headlines, the behavior. Does the market accept above it, or does it keep rejecting? Watch the dollar, not because gold is mechanically tied to it every second, but because a sustained dollar surge can change the short-term balance of pressure. Watch rates and the bond narrative. If yields rise because growth is strong and policy is credible, gold can cool. If yields rise because funding stress is rising and fiscal credibility is questioned, gold can stay bid. Watch volatility, not just the index print, but the way markets react to data. Do they calm down or do they overreact? Overreaction is stress. Watch related metals like silver. If silver is starting to move aggressively alongside gold, that's often a sign the broader precious complex is waking up. Part safe haven, part liquidity wave, part positioning. And watch the calendar. Month-end flows are not a myth. Options-related dynamics are not a meme. Thin liquidity windows can turn a small push into a big move. Now, let's land this with a clean roadmap, no theatrics. If you want the base case, gold holds above $5,000, digests in the low 5,000s, maybe dips back toward the handle and then pushes higher as the market accepts the new regime and flows stay persistent. Confirmation is stability above the level and a lack of sustained reversal in the macro drivers. Invalidation is losing $5,000 and staying below it while the dollar and real yields move against it. If you want the squeeze case, gold stays sticky above $5,000. Dips get instantly bought, and an upside acceleration happens into a thin window or an options-driven reflexive move. Confirmation is fast reclaim on any dip and impulsive price action through the recent highs. The risk in this scenario is gap risk, up and down. You can get rewarded quickly, but you can also get punished quickly if you confuse momentum with certainty. Either way, the key is the same. Don't let the market use your emotions as liquidity. If you're here for clean thinking instead of hot takes, you're already playing a different game. So here's your checklist for the next week or two. Keep it simple in your head, even if the tape is messy. Hold or lose $5,000. Watch the dollar and rates for whether they're signaling credibility or stress. Watch volatility for creeping instability. And watch whether dips are being treated like opportunities or exits. And one more thing, because it matters for trust. Nobody gets the top tick, nobody gets the bottom tick. And anybody promising you a guaranteed path is selling you comfort, not insight. If you want to be part of a community that watches mechanisms instead of narratives, stay close to the process. Drop what you're watching most: dollar, rates, spreads, physical premiums, options flow, so we can compare notes like adults, not like cheerleaders. Because in a regime shift, the market doesn't reward the loudest, it rewards the most prepared.